Good afternoon. I'm Andrew Serwick. I am a portfolio manager at Exchange Traded Concepts. I lead the portfolio management and trading team there. I've been there since 2018. And prior to that, for 18 years, I worked at Goldman Sachs. I led the Quant ETF Strats team and the Quant 1 Delta Strats team. Best execution is something that applies to both broker-dealers and asset managers. Broker-dealers have had rules going back for decades. Asset managers also have an obligation to minimize costs, maximize proceeds. And there's a kind of an accepted framework for this, having written policies and procedures, a framework for documentation, internal monitoring, and use of third-party consultants. With that, I'll turn to my panel to let them introduce themselves.
Hey everyone, I'm Ryan Severkel. I'm here from Susquehanna International Group. I'm part of Susquehanna's ETF sales and trading team. For those of you that might not be familiar, SIG is one of the world's largest ETF market makers. On a daily basis, we price over 3,100 ETF products here domestically. We also serve as lead market maker in over 400 ETFs and growing. Our key business lines are ETF execution, portfolio trading, the trades that happen within ETFs, as well as helping new and existing issuers launch product with seed capital and secondary market liquidity support.
Hi everybody, my name is Rich Lee, and I'm head of program and ETF trading at Robert W. Baird. Baird focuses on mid and small cap as well as program and ETF execution. And I'm based here in New York. The firm is Milwaukee based, and happy to be here. Thank you.
JC Maas, I co-head the equities product within BNY Mellon's markets team. So BNY Mellon, obviously a very big custodian and service provider to the ETF industry, but probably less known is our markets franchise. And we are dealers in ETFs. We are liquidity providers in ETFs, and we are, I think, ever present in kind of the ETF ecosystem, really connecting internally with the issuer community and the consumers of the products. Pass it along.
Hello, my name is Dan Madden. I oversee the capital markets at FlexShares, which is the ETF arm for Northern Trust Asset Management. It's great to have you all here today, and I'm hoping that my husky doesn't jump through and decide to partake in the panel like she has the past couple of years.
So we'll start. The SEC recently has put forward something called Reg Best X, which would apply to broker-dealers. We'll really be focusing, I think, on the asset management side and best execution requirements today. It's not something that was expected to have much impact, but is there anything going on regulation-wise or anything new that we should think about, Rich Lee?
Sure. So one of the things that have been on people's minds of late is all the proposed regulation out of the current SEC regime, and one of those things is Regulation Best X, right? And I think one of the things about Regulation Best X is a lot of market participants have kind of argued that there's a lot of redundancy from an execution perspective, right? Because prior to the introduction of Regulation Best X, FINRA has had its own sort of Best X requirements and has had most broker-dealers their own Best X sort of policies as well. So there's a bit of redundancy there. There's not a lot of applicability, but I think as we think about Best X in the context of execution in this panel, I think it's really about sort of aligning, customer intentions along with the tools and the liquidity that's available out there and marrying those two.
So when we think about a framework for evaluating best execution, a systematic approach usually starts by looking at some kind of a benchmark, right? A VWAP, arrival price, closing price. How should we think about what benchmark is appropriate, JC?
Yeah, no, it's a good question. So, I think what we talk about from a Best X perspective can be like, the FINRA version, the SEC version, which is, again, mathematically where the execution stands relative to the NBBO, relative to, Reg NMS, and what your question I think is mostly aimed at are, what are the nuances aside from that kind of, linear approach to Best X, and I think there are a lot, and I think ETFs, because of their nature as as effectively wrappers of other asset classes, deserve a more specific look from an implementation perspective. So, if VWAP is your benchmark, and you're trading, you're trading the vehicle, it might not be the best benchmark to use to determine whether you've had a high quality execution. If you're using arrival price, then implicitly you are prioritizing time over liquidity impact and price impact. If that's what you want to do, then that's great. I think the market overwhelmingly has chosen methodologies based on what is the most kind of common method, right, rather than what is the best method for that specific asset class. Fixed income is a great example. Fixed income doesn't, some fixed income products wrapped in an ETF don't necessarily have the same liquidity profiles as equities, and should be treated in different ways. NAV execution, spreads to NAV, kind of an underutilized method for certain liquidity profiles of ETFs, right? So I guess what I would recommend to the crowd, to the extent that if there are questions, would be speak to your providers, speak to your liquidity providers, speak to the Susquehannas of the world, speak to the BNY Mellons of the world, and speak to the issuers to better understand, I guess, or best understand the best way to implement based on your specific constraints. Everybody has their own constraints. Everybody has an emphasis on certain features, and I think the liquidity providers can be very helpful in that respect.
Yeah, I think just to supplement that, to JC's point, with regard to things like arrival price and VWAP, right, there's a difference between looking at aggregate data and sort of managing all your executions across all your brokers and looking at performance over periods and trends over time versus when you're actually doing a trade, what's the intention of what you're trying to do and how do you measure that benchmark, right? Is it liquidity? Is it price? Is it size? And so those two benchmarks may or may not necessarily align depending on what, again, the customer's intention is for the trade.
Yeah, absolutely. I mean, what we see on our side sometimes are, an RFP or an RFQ, an RFP for a specific, extraordinarily large size in illiquid assets. You're going to pay a large premium, a large liquidity premium. Most dealers are going to show that liquidity premium. Many consumers are going to pay that liquidity premium. The question is, do they always need to, right? And sometimes they don't. Sometimes they do. And I think that's a conversation that can be teased out, right? As clients talk to their providers. I don't know if you want to add anything, Ryan.
Yeah, I mean, I think there's no one size fits all, right? And it's a conversation where you have to identify what those constraints are exactly, and then we can help kind of guide it to the place it needs to be. And it's evolved too, right? So it's changed. It's not something that's been stationary. So depending upon what you're really looking to achieve when you're trading, I think it's something that conversation needs to be had before settling on what specifically is going to work best.
No, absolutely.
So JC mentioned RFQs, and speaking of RFQs, they've really kind of become a preferred method for executing a lot of ETF trading. They offer some things that are attractive, clear comparison of pricing. They put brokers into competition. What are some of the best practices for RFQs and scoring counterparties and deciding which counterparties to include in routing, right?
Yeah, Andrew, you're absolutely right. I mean, RFQs have really revolutionized how you go about finding best execution when you're looking at risk pricing. I mean, you've taken a manual process that used to take minutes, and now it's automated. You can submit a list of ETFs you're looking to trade to a list of counterparties and almost simultaneously get back a two-sided market. So it's allowed firms to scale, be more efficient. It's allowed them to alleviate a lot of operational headaches. And to your point, there's also that compliance piece that's built in. So we love having that conversation with different RFQ platforms. And for folks out there that are considering RFQ or expanding their usage of RFQ, I would say when we do speak about it, really kind of three best practices come to mind. It's automated, but it doesn't mean you still don't have to have a relationship with your counterparties. You don't want to be just a name on a platform without some sort of trading profile behind you. If there's unfamiliarity, that's uncertainty, and uncertainty is risk. And that tends to get reflected in bid-ask spreads. So just like you did before RFQ, you need to know your counterparties. Secondly, you have to know what they're good at, and not everyone's the best at everything. That's another thing that's always evolving. Certain market makers are great at certain asset classes, but you have to keep tabs on, who's been consistently good with the tickers that you trade most often. And people ask, well, how many people should I include in an RFQ request? It's probably not one or two. It's probably not 7 or 8. There's definitely a diminishing return at a point. And it's especially something you want to be cognizant of if it's an excessively large trade. If it's a large portion of daily ADV, you want to be more careful if there's some sort of risk of information slippage that you're concerned about. And I'd say thirdly, not everything needs to be traded on risk, right? I mean, there's a lot of times when, depending upon the order size, the type of product you're looking to purchase, where it makes a lot of sense to spread that risk out over time rather than just a single moment. So, while RFQ has been, a tremendous help and advancement in allowing people to be a lot more efficient, it's not something that should, replace how you think about different types of trades. You still have to kind of have that same knowledge base that you had prior. It's just this is a bit easier. So it's not an all or nothing type scenario is what I'd say.
When we think about ETF market making and liquidity provision, one of the things over the last several years is kind of a rise of central risk books and the ability of firms to provide principal liquidity. Dan, could you talk a little bit about that?
Yeah, so we think about going back 20 years in ETF trading, and it involved selling an ETF and immediately executing a basket, an underlying portfolio against it, right? So your impact cost was a cost to execute that basket effectively, right? But as we see the evolution between technology, between the implementation of portfolio management on the liquidity provider side, to Ryan's point, RFQ has gone from minutes to instantaneous. The reason being is the liquidity provider, when they execute an ETF, they're executing that portfolio of risk into a central risk book, right? Meaning every execution, whether it's 100 shares, whether it's 1 million shares, is pouring into a central book, a central risk book, where they offset that risk with a variety of instruments that are extraordinarily liquid. And they often are not that true basket right there. And so it gives them an elongated period of time. We talk about the idea of extending a time frame to mitigate impact risk. And that's exactly what the centralized book allows for it to happen. Digestion of that risk at the point of execution, and then offsetting that risk with alternative, more liquid, immediately liquid instruments, and then over the course of an elongated period of time, reducing that true impact of the portfolio that you're trading against the ETF itself. And so effectively what happens is the investor gains that value. They gain that, we'll say, that mitigated impact risk. The small time, that short time that was on demand at one point 20 years ago is now 2-3 days of unwinding that risk, unwinding from that truly instant derivative risk into that true offsetting basket where they can then turn around, create, redeem, and remove those positions off the balance sheet. And what that really has tremendous impact for is beta is beta. Beta is extraordinarily liquid. And there's nothing more, I always like to say, there's nothing more liquid than SPY in terms of a listed traded instrument. But what it really impacts is not beta. And that's truly valuable, especially I think about issuers. Flex shares is not iShares, it's not State Street, it's not Vanguard. But we do have we have a handful of ETFs that are middle volume, lower volume. And when we have groups that trade handling our products in a central risk book, they can trade our products, and it actually adds a tremendous amount of value. It puts those middle tier volume names and the lower tier volume names on the same level of liquidity and immediate liquidity as beta. And that's where truly, in terms of the evolution of trading from just trading the basket on demand at the point of execution to extending that time over 2-3 days, and stepping into that, stepping to the offsetting risk, not only through the trading, but also through the creation redemption that removes from balance sheet, it gives them that mid-tier volume product, low-tier volume product, that much more, so you can actually come to that, maximize that potential of liquidity in those products.
Manual index ARB and ETF ARBs, those were good times. I remember that.
They were fun times, especially on the floor. Everybody shouting and screaming. But, again, technology. Technology is great, right? Technology is exactly what has been implemented. Databases, I mean, you throw together a physicist, a computer scientist, a statistician, and a trader, and what do you get? You get some crazy ability to digest, first off, understand what risk is. 2, the ability to digest it cleanly and efficiently. And then 3, you get efficiencies. You get, I almost like to say, liquidity beyond what you can anticipate on that underlying portfolio. You actually get liquidity beyond that, because that extended time frame that they're given in execution, because they're offsetting risk in a different fashion. And they pool equity, U.S. domestic equity, international equity, fixed income, commodity risk, all into this central book. And actually, that's where the value is really developed.
I mean, I would only add to that equities, with respect to portfolio trading and the evolution of futures and the arbitrage of those, were naturally suited, right, for the ETF world, that came crashing through 20 years ago. But it took a while for fixed income to catch up, right? And arguably it's still evolving. Whereas liquidity providers like Susquehanna were at the front of the game, many years ago. Some banks and arguably the liquidity centers for those fixed income instruments, it took a while for them to catch up, right? Connecting the dots between the cash dealers on the credit side, on the rate side, and the ETF traders.
Yeah, I mean, I would say it's almost easier than that when the pricing itself is a direct reflection of who's managing risk well, right? So you don't even have to overthink it. When you're seeing that pricing that might be superior to someone else's pricing, it's probably pointing to someone managing risk better, whether it be through a central risk book or just, lining up risks that offset better. But that's how you know, right?
Yeah. I mean, giving the opportunity for dealers to show their axes and for those axes to ultimately benefit the end user, right, is a really unique feature.
I do love reminiscing about the good old days back on the Amex 20 years ago. I was one of those people doing the manual index ARB, 500, 2,000 stocks, equity basket. It's really amazing how much things have evolved. And this is a good transition, talking about the ETF underliers. Can we tie that back to, how I think about evaluating best execution, right? You talked about equity is pretty cut and dried, right? All of the market data is very easily accessible, very visible. Fixed income, more difficult. So how do I think about the underliers and how this kind of dictates what benchmark I should use when I'm trying to benchmark trades for evaluating best execution?
I mean, I would say the first thing you need to do is understand the asset class that you're trading, right? If you're heavily involved in high yield names, if you're involved in investment grade names, the more esoteric fixed income asset, elements, understanding how those products trade are important, because ultimately that's how the ETF is going to trade, right? And I know sometimes, you do benefit from that gray liquidity in the ETF space that is a net positive relative to the base asset class liquidity. But when you're trading extremely large size, you're going to default to the base asset class liquidity. And so that's what's going to determine the bid ask. That's what's going to determine the impact cost. And so, that's something that I think dealers like us, when we work closely with clients, we can model up, we can explain, and based on that explanation, provide various scenarios, and depending on that client's specific need or elements of focus, they can pick their their methodology.
Yeah, and I think it also has to do with like a maturation of process and regulation from the asset class side, right? You think about equities, we're so highly regulated, we're so highly electronic, everything is recorded, time-stamped. There's down to like the millisecond, right? So in terms of evaluating prices, looking at reference pricing, and looking at what's going on in the marketplace, it's fairly simple to do, right? But with some of these asset classes, like fixed income is, I think, is an example, right? I always kind of laugh because we sit behind the fixed income guys, and like all the problems that they're kind of going through were the problems that we went through in the equity space like 10, 15 years ago in terms of like increased transparency and becoming up more electronic, right? And so I think as these products become more and more traded, demand will dictate, hopefully, that things become more transparent as well from a market data perspective. And once you have the data, then you can kind of have a more full, holistic picture of what you're looking at.
I think, papers have been written about this, but, in the context of the tail wagging the dog, I think it's safe to say that over the last 10 years, the ETF industry has driven tremendous efficiency in the credit markets and other, other fixed income markets. Largely, partly responsible, I think, for the electronification of fixed income, partly responsible for portfolio trading of credit, which, has really grown in the last 5 years. And the reason for that is because it looks and feels like ETF risk, right? And so dealers are more comfortable.
That's a great point. I will credit, actually, I would say, sort of the ETF ecosystem for helping to push fixed income along in that space with regard to things becoming more transparent and electronic and sort of more readily available from a data perspective.
Something that in the cap market space, in particular from the issuer perspective, we're always looking to pair our ETFs with the groups that have the appropriate risk appetite or the risk expertise, we'll say. So whether it be, some groups are great at everything. Some groups are really good at every asset class. But there are other groups you're trying to pair U.S. domestic equity only, or international equity only, or fixed income, credit, rates. Where do they sit in terms of their ability to digest? So that when cap markets, we define not only a lead market maker, but also supporting market makers, so that when the centralized, their risk books alter or shift because of what they're trading, there's not only the lead market maker to participate, but also supporting market makers. So the dealers can actually they know, all right, we know five groups that are good and high yield. One day it's going to be Group A, next day it's going to be Group B, day 3 it's going to be Group C, and so on. So it might rotate over the course of time as these centralized risk books alter and tilt to what's being executed in the marketplace. And that's where, again, the importance of understanding who's involved, why they're involved, the executors, the broker-dealers, know where to reach out to.
Yeah, I might add, Dan, that's why it's so important to understand what's under the hood in the ETF. ETFs have gotten much more complicated in a lot of respects. They're multi-asset now. So, it's more than, having a specific prowess in one asset class. Well, we just had a group here that have options and equity all in the same wrapper. So, it's one of those things where you need to make sure that you're addressing both with whom you're working with from a counterparty perspective.
I have some more questions I could ask here, but maybe we'll pause and see if anyone from the audience has any questions for the panel. Yes.
I'll just scream. With the cost of capital materially higher this year than last, is that changing the way you hedge, the instruments you use, the use of capital, like your balance sheet, and what market impact it's having?
It's a good question. I would say that it hasn't materially changed the way we kind of view risk and commit capital on behalf of a execution for a client. I'd say that we're also SIG is a private company, might have the same constraints as other organizations.
Just as an awareness, when we think about that higher cost of capital, ETFs are built around the create and redeem process, right? And so your balance sheet is like an accordion. From a market liquidity provider, the balance sheet is like an accordion. It's going to expand and contract. And so you see those balance sheets creation. Well, you see it trading, expanding, and then create, redeem, contracting. And so they're trying to mitigate those costs. Now, there is a scenario where you're going to see, you'll see the cost of capital impact the pricing, but that's why in an RFQ you have to understand not only the lead market maker, supporting market makers, because at some given point in time, it's going to be more costly for the lead market maker, less costly for a supporting market maker, and that's who's going to do the best execution. And so you, again, the reason to find that support in the ecosystem is to actually mitigate those higher costs of capital, because that will be put into the price based on the dealer, but at some point, there's going to be a dealer that's the least cost. It has the least cost involved because their balance sheet has been collapsed already. And so again, that accordion effect in the ETF world is actually truly impactful in the ability to move on and off balance sheet and keep those costs lower, so to speak.
Yeah, no, I agree. But, cost of capital is part of models based on the expectation of whatever residual elements in ETF form or in any form is expected to stay on the balance sheet. I would say one of the impacts that it has probably is less on the RFP side or RFQ side, and maybe more in the premium or discount of the products, right? And reflective of kind of the natural flows in the primary market, reflective of the dealers' appetite for keeping certain assets on balance sheet. I would say the sec lending market is probably has equal influence, right? Names that are extremely expensive to be short because of whatever reason, are going to have an impact, sometimes more subtle than others on the kind of resting NAV, or again, subject to the flows, client flows, and subject to other factors. But yes, in a short answer, cost of capital and other factors are parts of the larger ingredients that drive pricing.
Any other questions? Something Dan just said actually made me think of a new question for our panel. When you think about creation redemption size, obviously large blocks bigger than creation size can easily be created or redeemed off the balance sheet, right? Small sizes often end up trading on screen. The displayed sizes are large enough for smaller. So is there a sweet spot, and what type of size of an order starts to become problematic, right? Where it might be larger, outsizes screen liquidity, but isn't large enough for create and redeem. How does create and redeem size fit into that?
I think I'm sorry to speak again, but I think there's an irony, right, in that in some products, larger size trades tighter than smaller size, which is not a natural way, at least for me, to think about things, but it's a natural way for dealers to think about things when you consider especially like fixed income, where odd lots trade significantly wider than round lots, right? So there are examples, and I'm sure Ryan can share them also, of a couple $100 million blocks trading tighter than a $20 million block, right?
Yeah, absolutely. I mean, the larger the size there, there's more optionality in that. It's easier to do. You don't have to worry about potentially having to take on inventory in a lot of those situations. So yeah, couldn't agree more.
So Andrew, this is where that development of the centralized risk book has been ultra important, right? So those tend to be we'll call it the middle tier or lower tier volume names, right, that have to be handled. They're not effectively executing that underlying basket. They're just putting it in this pot, stirring it up, and maintaining that. They understand it's that cost of capital, right? They're going to maintain this for 3 days, or the turnover is going to be 4 days. They understand it, and so they'll understand the pricing, the time frame which to hold it before they can create and redeem it off the balance sheet, but it's dropped into that pot of risk. And that's where, again, the middle tier and lower tier volume names have been actually really benefited from this centralized risk handling. Although you're right, JC, those big blocks, they go up unbelievably tight. And it's because, yeah, and I see it particularly in fixed income, because 20, 50, $100 million, that's trading. You don't trade fixed income, we'll say, in general. You're not going to say trade $20 million of single name fixed income anymore. It's been, you see the electronification, an earlier panel with fixed income. Kat was talking about market access and electronification of fixed income. You see a lot smaller lot trades. Well, a lot of smaller lots, a lot of real, we'll call them odd lots. The round lot is in the ETF, and there's where you see that improved pricing in the ETF.
Yeah, and I think as opposed to, as you pointed out, is it a size issue in terms of creation redemption size? I think it's to Dan's point about the centralized risk books, and if it lines up with what you're doing, size may actually be advantageous to a more advantageous price depending on what the inventory is in the book.
I'll say something else quickly, something that we've seen a lot of, and I think it's because we're really close to the ETF custody folks and ETF service providing folks. You know, many lesser tier products, when they come in, are illiquid. When issuers come out with a new product, you know, you're going to have some degree of seed capital. You're going to have, you know, wider bid ask than when you have a product that is mature. But what we've seen a lot of, actually, is self-seeding among issuers, right? And I think that's probably worth talking about, because newer products that I think consumers, institutions, RIAs used to stay away from because when they were brand new, they were a little wide, a little clunky. You're seeing less clunkiness because dealers are now having access to pretty much odd lot liquidity, right? So the idea that you know, trading. I mean, if you're a dealer and you get lifted on 100 shares of something, and the minimum creation size is 50,000, you're going to end up, you know, long 49,900 shares of it, and you know, and that's you know, there's a cost of capital, there's a risk associated with that, and the self-seeding element where issuers can seed a portion themselves and feed the market that inventory in smaller size until their products mature is having a really positive impact on bid ask for new products.
Yeah, from the issuer standpoint, ultra short, we could do less than $1 million on a creation unit size, right? Because you can do those small round lots in a portfolio trade to handle that scenario. But when you get to emerging market, you have to have $3 or $5 million. So the idea of having a seed program or a borrow program, which I think is equally important. You talked about the sec lending as important as facet. Sec lending is equally important. So either having that seed process or the sec lending available that gives we'll say the liquidity provider the ability to keep that until we'll say maximize the point at which they can create or redeem that off their books is the ideal scenario.
I think we're approaching the end of our time, but any closing thoughts? How can ETF issuer capital markets desk be helpful in navigating best execution? How can broker-dealer trading desk be helpful? How can I kind of use this network of experts to help me navigate this topic? Right.
Yeah, I would say simply, you know, engage with them at the right time. You know, 15 minutes before a trade, it's better than never, right? But it's good to get to know these folks. I'd say the custodian block desks are incredibly sophisticated, standing ready to help. So if something doesn't look right, if you're unsure of something, it should be kind of one of your first lines of defense in getting, you know, kind of information on how to proceed forward. So, you know, they're there for a reason, for sure.
Yeah, I'd supplement that. You know, we're an agency-only shop. I love data analytics, love solving workflow problems. So for us, it's having a conversation with your customer and kind of, again, coming back to like, what are your intentions and what are you trying to accomplish? And then us marrying that with the tools and liquidity that's out there to get you the best price from an execution perspective.
Yeah, I mean, 100% agree. You know, that degree I mean, I'll be honest, I don't see enough of that degree of communication, right? I don't see clients coming in early enough, right, and having those conversations, and knowing maybe that the you know, that the dealers or you know, the high touch desks or the custodians have answers, right, can guide in the right way, can provide objective data that can help you make the right decisions. So my only suggestion would be, you know, leverage that, right? Don't hesitate to reach out and ask questions and you know, and help yourself.
From the cap market side, that's effectively, we'll call it, that's our job, right? To make sure that investors understand how they can execute. But even more so, it's our job to make sure we're communicating to the dealers that are handling the clients. And I actually, one of my favorite comments, there was a panel just a little bit before, they said, only 20% of RIAs know there's a centralized trading desk or a high touch desk at their custodian. That's crazy. That's actually my first comment is, who's your central desk, and why don't you work with them directly? Capital markets provides detail about the asset class, who the market makers are, when you might trade, how you might trade it, why you might trade it, but then put it in the hands of the professionals. RIA, as I like to say, RIAs are professional advisors. They're managing portfolios. They're managing when they do tactical changes, strategic changes. That's what I want them to be great at. I want the trading desks to take care of all the other business so they can implement those thoughts by the RIAs.
Great. Thanks, everyone.
Thank you.